Good morning. Ladies and gentlemen, thank you all so much for taking time out of your day to be here with us. It's really exciting to welcome you to the 2023 Merchants and Marine Bancorp Incorporated Annual Shareholder Meeting. As is customary, we will begin today's meeting with an update from a renowned economist, Dr. Craig Lewis. For those of you who were able to join us last year at the annual meeting, you got to hear a little bit from Dr. Lewis in terms of his outlook on the economy and his outlook on our company. And he did such a wonderful job, we thought it would only be appropriate to have him back. But to give the proper introduction for Dr. Lewis, I'm going to introduce our company's Chief Financial Officer, Casey Hill, who has an intimate knowledge of Dr. Lewis, actually studied under Dr. Lewis at Vanderbilt. And so without further ado, Casey.
Good morning. As Clayton said, I'm Casey Hill. I'm the Chief Financial Officer at Merchants and Marine Bancorp. It's a great privilege of mine to introduce our economic speaker who is here with us for the second year in a row, as Clayton alluded to. And I should also point out, or would be remiss if I didn't, that in reviewing Dr. Lewis's presentation last year, every single thing that he prognosticated came to fruition over the course of the last 12 months. So it's probably a good thing to listen to Dr. Lewis, as I, in my career, have never seen that happen with an economic speaker. Dr. Craig Lewis is the Madison S. Wigington Professor of Finance at Vanderbilt University's Owen Graduate School of Management and a Professor of Law at Vanderbilt Law School, where he has received a multitude of awards for teaching excellence. He earned his PhD and Master of Science in Finance from the University of Wisconsin and his BS in Accounting from The Ohio State University. His areas of expertise include corporate financial policy, asset valuation, convertible debt financing, corporate capital formation, and forecasting market volatility. In addition to his academic accomplishments, Dr. Lewis also has the distinction of being the former chief economist at the Securities and Exchange Commission and director of the SEC's Division of Economic and Risk Analysis. As a former student that likely tested his patience more than once, I will also add that in addition to all of the accomplishments listed above, he is also a gentleman in every sense of the word and just a wonderful human being. Ladies and gentlemen, please help me welcome to the stage Dr. Craig Lewis.
Thank you, Casey. Thank you for the kind remarks. I'm not sure all of them are deserved, but I'll gladly accept them anyway. Good morning, everybody. I'm going to be talking about a couple things today, but before I get started, I see we have some students from Mossville High with us today, so welcome to the meeting. I'll encourage all of you to think about Vanderbilt as your choice for college when you graduate, so don't hesitate to apply. But I'm going to talk a little bit about some things that are similar to last year. Did I get it? Yeah. So what I want to talk about is I'm going to take a slightly different take than the presentation I made last year. I am going to talk a little bit about current market conditions and what's going on in the stock markets. But instead of making a lot of forecasts about where the economy is headed, I'm going to talk about some current events, and that is the recent bank failures that have taken place in this space. We've seen Silicon Valley Bank, Signature Bank, First Republic, all basically have failed in the last month or so. And I thought it would be interesting to talk about why did that happen? You know, what caused the problems at those banks? And using that, I'm then going to spend some time talking about what is going on at Merchants and Marine Bank and how does it compare to the banks that failed. And so the way I'll motivate this is I'll develop a couple factors that I think were critical to explaining what happened at those banks. And then I'll say, here's where your bank fits, and I'm going to compare your bank to a set of 16 other comparable banks. And so we'll try to put it in perspective, and I think the takeaway that you're going to have after this presentation is that Merchants and Marine Bank is is it the best position of all these comparable companies to withstand what's going on in here? And so when I started this, I had no idea where this analysis was going to go. But when I finished, it was clear that you were ranked number one among all these different banks that I looked at. And then given some of the problems that have taken place over the last day or so with PacWest Bank, I thought I'd show you where PacWest looked relative to these other banks as well. And you'll see that they don't look that good. And so the factors that I was using to rank Merchants and Marines against its competitors shows that PacWest probably was sort of a laggard relative to even the companies that I looked at. So we'll finish up with that, and then I don't know how long that will take, but to the extent that I have a little bit of time left, because I am the former chief economist at the SEC, there's been an incredible amount of rulemaking at the SEC over the past few years since Gary Gensler became the chairman. And in particular, I think that as a shareholder in a public company, you should be interested in what the SEC is doing with respect to how you trade stocks. And there's some fundamental changes that are going to take place in this space, specifically with respect to how you will interact with markets. And I thought you'd be interested to hear what the SEC is proposing to do. None of this has been passed. There's still proposed rules, but there will probably be a move to finalize at least a few of them. So as we go forward, I'll try to figure out how to advance my slide here. All right, so current market conditions. We're going to talk a little bit about where the markets stand, stocks and volatility, and then I'll make a few comments about inflation. Maybe I have to get really close. There we go. So this is where, I don't think that's my first slide. Did I skip through one? There we go. Okay, there we go. So I presented basically this exact same graph last year. And so what I did was I added basically another year's worth of data. And what I'm showing you here is the blue line represents the S&P 500 index, which is a broad-based market-weighted index of the 500 stocks. And what you can see is that if you started back here February 22, 21, I'm not sure why I picked my birthday, but I did. And so we go through, and what you can see is over the year 21, stock markets did pretty well. They came down. There's been a fair amount of volatility in markets over the last year or so. If you look at the end here, sort of steadily coming back, but they haven't performed quite as well as we might like. If you look at, I put in a corporate bond index, and what you can see is that they tend to move together, right? But corporate bonds have done a lot worse. The next thing I'm going to do is show you basically what happens now when you compare a bank ETF. So this is a portfolio of bank stocks. So how is the banking sector done? And I've also put in Bitcoin, just so you can see how crypto assets were doing at the same time. So what you can see, I think, from this graph is that the banking sector has really performed very similarly over time to the S&P 500, right? So it's performed a little worse, right, recently, but so if you look at what's happened in the last few months, the very right edge of my graph, what you can see is bank stocks took a very large downward move, largely because of Silicon Valley Bank and the failure there. And so while they were performing during the year better than the S&P 500, they took the big hit, but since they did drop in price, they've tracked pretty closely. I think if I extended that out another couple weeks, we would see another drop in that, but there's a lot more volatility in the banking sector than what I think we've been historically accustomed to looking at. And what you can see is that the one asset class that seemed to do quite well when the bank stocks dropped were crypto assets, right? So Bitcoin, Ethereum, all went up quite a bit when Silicon Valley Bank collapsed. And so now here's what I wanted to show you this graph. What I've plotted on this graph is, once again, it's the S&P 500 index. The green dotted line is a measure of volatility in the stock markets. It's something called the VIX. And the VIX is, think of the VIX as an index that provides a forecast of future volatility in the market over a very short, like 30-day window. And what you can see is that there's been some spikes in volatility, but interestingly, the VIX index also tended to go up, right around the time that the banking sector had its problems. So market investors are responding to current events, right? And when something bad happens in one sector that causes people to rethink their views on the economy, then volatility goes up in the market. And I think investors appreciated that volatility went up. What was interesting, though, is just how quickly it came right back down more to historical levels, and it's been trending up again more recently. So I think if you look at that, one of the really interesting things that you'll see is that when the market goes up, the VIX level goes down. And when the market goes down, the volatility index goes up. It's kind of making that basic point that I make when I teach my valuation courses, and that is that the investors require a return that compensates them for the risk that they're taking on. So if investors believe they're taking on more risk, the return that you require goes up, and what you're willing to pay for the security, of course, goes down because you want to make that return. So that's the S&P 500. Okay, let's go back here. I'm going the wrong way. It doesn't quite want to cooperate with me. This reminds me of, all right. So I'll tell a little story. This reminds me, Casey, can you somehow just fast forward that one more? Thanks. All right. So this reminds me of a presentation. My son went to a high school in Nashville, right? And they had this speaker, this end-of-year speaker. And the end-of-the-year speaker he was saying his presentation was about how to deal with adversity. And he was saying, he had all these, really nicely prepared speech about dealing with adversity, and his presentation was doing about the same thing mine was. And he got more upset and basically undermined his complete discussion by showing how frustrated he became with the technology not behaving for him. So I'm not going to be that guy. So I want to make one quick comment about inflation before I talk about bank failures. And inflation is here to stay, right? I mean, it's not going away. It's going to get worse before it gets better. Until the Biden administration figures out how to stop handing out money and starting new programs, and we start spending money we don't have, right? Inflation is not going to get better. It's going to get worse. You pay the price. Whenever you spend money, somebody has to pay for that. And the way it's going to be paid is by issuing more bonds, more treasury bonds. Basically, inflation will cause interest rates to go up, right? And I think that's something that we're going to live with for a long time, and I don't think they're coming down anytime soon. So let's talk about these recent bank failures. Silicon Valley Bank. In terms of scale, it's the 16th largest bank failure of all time. Signature Bank is the 19th largest bank failure of all time, and First Republic is the second largest bank failure of all time. So these happened in a very short period of time, and they're all incredibly significant events. So what caused these banks to failure? Why did they crater? Okay, so I'm going to argue that there are three things that can cause a bank to fail, right? And it's the stability of your depositor base. Okay, so what happened at Silicon Valley Bank? It was basically the bank of venture-backed VCs, tech, life science VCs. So think of bio-type, pharma-type companies out on the West Coast. And so they had an incredible amount of lending to these, and in exchange for providing these loans, they encouraged those companies to deposit money. The entrepreneurs deposited their own money and maintained balances at the bank, right? So 93% of all the deposits at Silicon Valley Bank exceeded the FDIC guaranteed limit. So for the high school students, if you have a savings account or you have a checking account at a bank, the federal government will guarantee that no matter what happens to that bank, if you have less than $250,000 in your bank, which I assume all of you have less than $250,000 in your bank, that if the bank fails, the government will pay you back and you won't experience a loss, right? Well, at Silicon Valley Bank, 93% of all their deposits were above that limit, and they weren't insured. You get $250,000 back, but anything above that is not guaranteed. Now, if you are one of those depositors and you think something might be happening at your bank, what is the rational thing for you to do? Get your money out of there before it collapses, right? That's called a bank run. When the depositors lose confidence in the bank's ability to guarantee their deposits, they leave and find a safer spot for their money. So in this case, this is an issue because to the extent that you have your depositors under that $250,000 limit, then you're much less likely to leave because your money's safe regardless of what happens. So one of the things that is important in a bank is to look at what fraction of those deposits they have that are less than $250,000, right? It's kind of a measure of how likely your depositor base is to run if something bad happens. Boy. The second thing we're going to talk about is interest rate risk. Now, banks do a lot of things with your money. All right? And in this case, one of the places where banks put their cash is in U.S. Treasury securities. Okay? So on a bank's balance sheet, they have a lot of assets. Some of those will just be investments that they've made with the deposit. So imagine you're a depositor, the money's coming in to the bank has this cash, but before they make a loan to somebody, they have to do something with the money. So they invest it in Treasury securities. And the reason they invest in Treasury securities is because there's an entire regulatory regime that supervises banks. And they have to maintain certain capital levels, and they get credit for, and the capital that they have to post is a function of the assets that they hold. And so if you hold Treasury securities, they're viewed as riskless from a bank regulator because we don't think that U.S. Treasury securities are ever going to default. Okay? So the regulators give you full credit for that. So banks put their money into Treasury securities because it helps them with their capital requirements, and they don't have to keep as much regulatory capital. So what happens is some of these banks decided that when they had treasuries, they wanted to earn a little bit extra money. And typically the way you earn a little bit of extra money in the treasury market is you buy longer term treasury securities. It just, for whatever reason, the interest rate that you historically earn on longer term securities, treasuries, is higher than what you earn on short-term Treasury securities. Now, the difference is incredibly small, but that didn't deter some of these banks from chasing that little bit of extra yield. And so what happened was Those longer-term bonds are incredibly sensitive to changes in the interest rate. And so when interest rates started to go up, these bonds went down in value. A short-term bond doesn't go down in value very much. A long-term bond goes down in value a lot, maybe 13 to 14% overnight, if the rate goes up a couple percentage points. So all of a sudden, these banks who thought they were holding this high-quality, riskless security found that interest rates going up the way they have recently, they had significant losses on their investments in these Treasury securities and put them underwater. And this is really what caused a lot of these depositors to become concerned, because now all of a sudden, it doesn't look like the bank is solvent anymore, because the losses on some of these Treasury securities were so large that they were actually underwater, right? And so the depositors, recognizing this, and decided maybe it was time to leave. All right, and then the last thing I want to talk a little bit about is liquidity risk. This one. And so one of the things that we worry about with a bank when something like this happens and depositors begin to run from your bank, do you actually have the cash to pay them so that they can leave the bank? And so another problem that happened at Silicon Valley Bank is they didn't really have much in the way of cash, right? And so the depositors who wanted to leave quickly overwhelmed Silicon Valley Bank's ability to let those depositors take their money out of the bank, which is why the bank stopped. So companies, banks that hold significant amounts of cash, significant levels of short-term Treasury securities are in much better position to withstand depositor withdrawals. So that's what happened at Silicon Valley Bank. Maybe not, Casey. All right, so what happened at Signature Bank? Pretty similar story. I mean, these things, the same macro events that affected Silicon Valley Bank affected everybody. So what was Signature Bank? They had sort of a different business model than most banks. What they did was they courted high net worth individuals. They actively sought out people that had a lot of money. And they provided what they considered to be kind of a high-touch business, right? And so their clients they did a lot of law, they had a lot of law offices, they had a lot of real estate buyers. They also catered to crypto companies. I think Coinbase had most of its cash deposited in Signature Bank. But so 25% of all of its deposits were from crypto firms. And when crypto collapsed initially, that was a big event for them, and those firms needed money, so they withdrew money for their own business reasons. But at Signature Bank, 90% of all their deposits exceeded that federal guaranteed limit of $250,000. So Signature Bank, all the depositors in Signature Bank watched what happened at Silicon Valley Bank. They saw everybody leaving. That created almost a panic type situation. And this is what the prudential regulators worry the most about, is that people will see what happens in one bank and that it will now affect their bank. And so depositors start to run, even though maybe Signature Bank was in better shape, but the fact that they had 90% of their deposits, that meant these were the customers who were the most at risk and the most to lose, and so they started to withdraw assets as well. They had relatively low liquidity, so there's a lot of this liquidity risk. They did not have very much, the Signature Bank didn't have much cash. All right. So what happened at First Republic? Actually, they didn't look nearly as bad as either of these other banks, right? They still had a significant amount of their deposits that were above this minimum, 68% of their deposits, but they made a lot of loans from their deposits. So 92% of all their loans were derived from deposits. And that's what a bank does, right? The bank takes your money, and then it uses that money to make a loan to somebody else. And the difference between what the bank pays you and what they charge somebody who's borrowing, that's how they make their money. Well, they had a disproportionately high amount of loans relative to deposits, which meant that they were sort of exposed to this same type of run-like behavior. All right. They had one of the features of this of First Republic that made them different was that they offered very low mortgage rate loans to their preferred customers. Mark Zuckerberg had a really nice loan from First Republic Bank, right? And so they offered really low interest rate loans, but they also paid relatively low rates of interest on their deposit balances. And because they had a lot of wealthy individuals, as soon as the interest rates started to go up, if you're not making very much on your deposit, and there's an opportunity to make significantly more by putting your money in somewhere else, they found depositors running because they had better opportunities at other banks. So they just left First Republic in search of higher yield. It could be as easy as buying a treasury bond or a treasury bill. So this caused, I think, a lot of the instability at First Republic. All right. So I'm going to talk a little bit about why we got ourselves in this situation in the first place. And much of this is, I think, the result of the actual prudential regulation that takes place in the banking sector by the Fed and the FDIC, right? So there are a lot of different, so what I mean by prudential regulation is I worked at the U.S. Securities and Exchange Commission. We're called a disclosure-based regulator. And when I mean a disclosure-based regulator, the SEC is interested in providing investors with the information they need to make investment choices. So as a public company, if you are traded on an exchange, you're going to be filing annual reports, a 10K. You're going to be filing quarterly reports, 10Q. You have all kinds of disclosure requirements if there's significant events, like an 8K, right, which is any material event, you actually have to tell your investors that that took place, right? So that's a disclosure-based regulation. The Fed and the FDIC have what's called a prudential regulatory policy, and that means they actually go into the bank itself and they track and monitor what's going on in the banks in real time, right? So the SEC, a disclosure regulator, doesn't track its companies in real time. A prudential regulator does. And so they set policies, and they tell the banks that you have to do things. All these banks that failed, they were deemed to have adequate levels of capital. So according to the prudential regulators, they shouldn't have failed because the amount of capital they were supposed to post was designed to prevent failures. Capital in a bank is a little bit of a buffer between the loans and the deposits, right? And what the capital does, that's the equity in a bank. That slice is there to buffer against runs. So if there are runs and losses with runs, the equity holders are the ones that basically realize or incur those losses. So the banks were compliant with all the capital requirements, but after the financial crisis of 2008, when all these large banks failed, right? We had sort of the meltdown in the banking sector, right? When Lehman Brothers failed, Bear Stearns had problems, right? So the big problem there was something related to default, right? That these banks, they became over-concerned about asset defaults, not liability defaults. So what happened at these banks is that the assets they were holding became worthless, and it caused these banks to go down. So the regulator said, well, let's make sure that we kind of shore up the asset side. So all of these regulations that Dodd-Frank passed was just designed to force the banks to hold what they deemed to be safer assets, like treasuries. So the banks had to hold a lot of treasury securities, but they didn't worry about interest rate risk because coming out of this environment, interest rates were close to zero, right? So there wasn't and the Fed was basically telling all of us that they were going to stay low for a long time. That's really what encouraged these banks to chase yield, because they felt if interest rates are going to stay low for the next 10 years, I might as well go out and buy some long-term treasury bonds. And it was this overemphasis on asset risk and the ignoring of interest rate risk that got everybody in trouble. And the way the prudential regulators track this is they force banks to do something called a stress test. And the stress test that they do is it's basically an exercise where you say, if a certain event happens, how much are we going to lose? And they had all kinds of bad things happening. The one thing they didn't bother to be worried about was a change in the interest rate. Interest rates were close to zero. They figure it's not going to go lower than that. How much? I have 20. Oh, I'm talking way too much. All right. So basically what happened was that they didn't worry about higher rates. Why don't you worry about higher rates? Because in your mind, they're not going to go up. So they actually didn't put it into the stress test. If that had been part of the stress test scenario, you would have been forced to hold a lot more capital if you held these long-term treasury bonds. They didn't. I think it was more of a political choice not to acknowledge that interest rates could go up than it was an economic choice. And so you have politics creeping into the prudential regulatory regime, and as a result, I think this is why they bailed out Silicon Valley Bank. They did it to prevent other bank runs, but the reason they went in and I don't know if you know this, but at Silicon Valley Bank, not only were the accounts under $250,000 going to be insured, the FDIC and the Fed came out and said, we'll insure everybody. No one's going to lose. In my view, that's bad policy. If you take a risk, you should be forced to realize the downside that can be associated with that risk. I would not have bailed those banks out. I would have let Silicon Valley Bank go down without the guarantees. Okay, now let's take a look at where Merchants and Marines Bank sits. All right. So I selected a set of banks that I thought were comparable. How many of you heard of ChatGPT? All right, so what I did was I went in and I said, ChatGPT, I said, I want you to identify a set of comparable companies for Merchants and Marine Bank. And ChatGPT gave me a list of banks back. And I used those banks in my analysis. And then when I made this presentation last year, I had a different set of comparable banks. So I wove in some of those additional comparable banks. And here they are. Bank of South Carolina, Bank First, Cambridge Bancorp, Community Bank of Mississippi. A lot of these are very similar. They have similar profiles to Merchants and Marine Bank. But I did put in some relatively large banks like Renaissance Bank, just to give you a feel for what a big bank looks like compared to a community type bank. All right, so those are the banks, and I came up with some metrics. So the first thing I thought, I did this last year too, and one of the things that always strikes me about your company is how, in my view, dramatically undervalued it is in the market. Right? This is, in my mind, is a buying opportunity. It continues to be a buying opportunity. What I did was I put the price to book ratio. So this is the market price of a share of stock divided by how much book equity you have. Right? And in the case of Merchants and Marines Bank, you're paying less than $1 for book value. Right? This is a huge deal. And so so what I've done, I just simply ranked all the banks in my comparable set. This is as of 12/31. And what you can see is this is before the crisis really kind of broke out, and they are well below everybody else. And many of these banks are trading at premiums to their book value, which is what you would normally expect a company that's doing reasonably well to do. If you have a solid company, you expect the price to be at least worth the book assets of the company. The fact that it's less tells me it's undervalued. So I did the same thing as of May 1st, and on May 1st, Merchants and Marine Bank actually went up. I actually think if you did it today, it would be back down, but unfortunately, it's still one of the most undervalued banks. You can see that some of these banks, which actually, like Renaissance Bank, Renaissance Bank looked pretty good. It was basically a dollar for dollar prior to when when all these troubles at Silicon Valley Bank. Now you can see that investors have basically caused Renaissance Bank to become much lower priced. So these banks that now that have now doing worse than, let's say, Merchants and Marine, they're there because they aren't doing so well, and investors are recognizing those banks are problematic. All right, so now let's look at, the way you should look at these slides is whenever you see a green bar, that's where Merchants and Marine Bank is. And so these are capital ratios. So this is how much equity capital you have. Equity capital is that amount that you hold to buffer against problems. So across all the banks, Merchants and Marine Bank has the second highest level of capital. Interesting, Renaissance Bank has the highest level of capital. This was measured on these, because most of these, I extracted this information from what's called a call report. And call reports are required disclosures that banks have to make to the FDIC. All right? And so many of these companies haven't released their first quarter in 2023 call reports. So to get my comparables, I had to use the 12/31. So think of this is what it looked like before everything went crazy in the banking sector. Right? And so before anything happened, Merchants and Marine had the second best capital ratio relative to all the other banks, which to me indicates it's pretty stable. Now, this slide thinks about the situation at Silicon Valley Bank, and this measures the ratio of insured deposits to uninsured deposits. And you want a higher ratio, because the higher that ratio is, the less likely the depositors are to leave the money. That means I have 15 minutes. Actually, it means I should probably shut up by now. But I'll go through this real quick. And so your bank has a ratio of 59%. So 59% is the ratio of insured to uninsured deposits. And what you can see is out here, these are the banks that have significantly more uninsured deposits. So the way you look at this bank, you want to be as close as you can to the spot, and you're basically in fifth place there. So you're not on top of everything. Here's one where it's the ratio of loans to deposits. So the more loans you have, you basically want to have a low loan to deposit ratio, and so Merchants and Marine Bank looks like they're about fourth place there. All right. This is the ratio of the amount of cash Merchants Marine Bank has to deposits. This is what you would use to pay anybody that wants to take their money out of the bank. And you have the highest ratio. You have 12.4% of your balance sheet is in cash right now, and that can be used to pay any depositor that wants to leave. And you can see that some of these banks have incredibly small ratios when you get out here. But Merchants Marine Bank really stands out relative to everybody else. Here let me go back there. All right. So this is a measure that I put together that says if depositors were to leave and you had to sell your investment portfolio, the assets that are the easiest to sell right now are ones that have fairly short maturities, right? Because they don't have nearly as much loss. It's a much more active market. And so I took the ratio of these short-term investments to deposits, and what you can see is that Merchant Marine Bank has 16.8. I got the green bar wrong there, but so about 17% of all your deposits are backed by short-term securities. So combine that with the really significant amount of cash that's on the balance sheet, and you can see there you're able to withstand a lot of stress on your deposit base. This is my measure of how much exposure you have to interest rate risk. So this is the ratio of investments that have, of your treasuries that have a maturity of more than 5 years to total investments. And what you can see is that Merchants Marine Bank hasn't been afraid to dip its toe into longer-term maturities. 51% of all of its investments are in longer-term securities. But compare it out here to Southern Bancorp or FFD and Renaissance Bank, and you can see that there are some firms that have significantly more. So Merchants Marine Bank is exposed to some of these fluctuations that are taking place in the interest rates. But given how much cash they have on their balance sheet and how much short-term, it's not really an issue. And so what I did is I took all these together. This is kind of a heat map. This just shows all these different factors and where Merchant Marine Bank put itself. So these are the various rankings. And I did this for every single bank. And what I did was I just took the average ranking across all these different factors, right? Each of these factors, and I just said, what's the average? And Merchants Marine Bank came out on top. When you looked at all these different rankings, its average rank was the best across all these various metrics I put together to describe what might cause a problem at a bank. And so we did that, and then maybe I'll close with just a quick discussion about Renaissance Bank, or PacWest. So where does PacWest sit into this analysis? It would be, if you looked at some of these ratios, I basically pulled its call report this morning, and the ratio of insured to uninsured deposit at PacWest is 42%. That put it pretty far out on the tail. It was out of the 16 banks, add in Merchants Marine Bank. So now we're ranking 18 banks. It was in 12th place. Right? So not good. What's the ratio of cash to securities to deposits? It's 14%. That put it in 11th. What is the ratio of loans to deposits? Put it in 12th place. What's the ratio of how much interest rate was it exposed to? So the ratio of long-term securities, it's in basically last place. And if you look at how much treasury securities it holds relative to deposit, it has one of the weakest ratios of that as well. It's in 16th place. So if you put all those ratios together, it looks like a bank that would not be ranked very highly by this scale. Right, so clearly well below median, right? And so that could explain why it's lost about 40% of its value overnight, right? So that's what I have. I think we wanted to hold a little bit of time for Q&A, so we'll just maybe pivot to that.
Craig, if you want to take a seat, we'll do
Okay.
Q&A. I think if we can put the number to text on the board. And we'll format this the same way we have in past years, where we'll have the ability to text in, and that number should be on the board in just a second. And in the meantime, we can also take questions from the audience if y'all have any. Thank you for the analysis on the banks. I'm glad that we fell where we did. It was something that we've looked at for quite a while, and I will point out that we have gone out on the securities curve a little bit in the last couple of months, but it has been in the last 6 months or so that we've done that when interest rates have kind of gotten to where they are. So hopefully we were at the top of the curve when we took that.
With your analysis, do you have any predictions of what other banks might fail in the near future?
Do I have any vision for which banks might fail? If I don't have my clicker anymore, but if you would go back to the that last slide, if I would say that the ones that are at the bottom of that chart are the ones that are the most likely to have problems. So according to my analysis, the one that is in the most trouble right now is Cambridge Bancorp, followed by Home Loan Savings Bank and FFD Financial, which I believe is a private bank, and then Lions. Those are the ones, according to my analysis, that if you were to accept my analysis, those would be the ones that would be at greatest risk. Be interesting to see how some of those share prices did over the last couple of days.
And we had an interesting conversation actually last night with a couple of the bank's investment bankers, and it revolved around chicken or the egg kind of mentality. Could stock price falls cause a run on deposits because the depositors are scared, or are depositors causing stock price falls? And it seems like both.
It's both. They're both endogenous, right? When you see the stock price dropping, that's a signal to people that weren't paying attention that maybe they should have been paying more attention.
And we saw a good bit over that last night. I think there are 5 or 6 regional banks that have more than 30% fall in their share price in after hours trading. So that was kind of concerning to see.
Any of them up here?
We got a question up here. You mentioned inflation, and obviously the Federal Reserve increased short-term interest rates again yesterday. We're from the mortgage side, and our economists with the Mortgage Bankers Association have been predicting interest rates to drop again. And really, they were anticipating interest rates to drop in June and July. Based on what you're saying, that doesn't seem that's going to be possible. Your thoughts?
My thoughts are I would find it, I don't think interest rates are going to drop. I think that the government is continuing, right, to have programs that need to be funded, and I don't see how we're going to stop inflation until we kind of get past that. And if you really think about it, where they are today, it's not that far off historical interest rate levels. So, when I first graduated from the Ohio State University, I got a loan on my first house at 11.25%, right? And that was my mortgage rate, right? And I was investing my money in a money market fund and earning 18% on treasury bonds, right, basically. So when you see the interest rate environment we're in today and we think it's near zero, I don't understand how it ever got below zero, close to zero, but I think we're at what I would view as kind of a long-run historical rate that may even today, is a little bit below historical rates that we've had in this country. When I was a kid, you got 5.25% in a passbook savings account, right? And the mortgage rates are above that. So to me, those rates in the 6 to 7% range seem more like the historical long-run average. I don't think we're doing anything to dial back inflation. I don't think government spending is going away. So I think we're kind of there for a while is my prediction.
Another question back here.
Good morning. Thank you for the presentation. So you explained the effects of banks investing in long-term treasuries when rates are low and the effects of interest rate changes when those rates go up. Can you, for the audience, discuss if a bank, let's just say timing is right and they invest perfectly at the height of that bell curve and things do start to come back down, the effects of a bank investing in long-term treasuries at the right time?
So the question is, let's flip it on its head, right? And the point I was making is when you're looking at a rate that's close to zero, there's only one way they can go, and that's up. So there's virtually no upside on an investment in a treasury, but there's a lot of downside, and that's what banks are facing. Now, if you are thinking about investing in a treasury after rates have already gone up, now you're trying to lock in at a higher rate, right? So let's say it's 2.5%, right? What can happen is if rates go up again, they're going to go back down. You're going to lose money. But because the rate is above zero, if rates were to go down, as you're predicting, then all those investments you've made in treasuries are going to appreciate and they're going to go up in value. So when rates are at a non-zero level, you can win and lose. When rates are at a zero level, you can pretty much only lose, right, in terms of capital appreciation. So if you time it perfectly, as the questioner said, then what timing it perfectly means is that you think you've hit the high. And now you're thinking, I only see good stuff. I don't really ascribe to that view, but to answer your question, you would basically make money if you did time it right.
We did have a question come in from the great beyond. Do you think the Fed has the tools necessary to battle inflation and win?
They're in much better position today than they were a year ago, because when the interest rates were zero, they lost their primary mechanism for battling inflation, right? And they had to try to do other things, right? Like quantitative easing programs. When the interest rate is non-zero, you have more tools in your toolbox to battle inflation. So at the margin, yeah, they have more tools.
Yeah.
Appreciate the presentation, really good. I have a question about the Treasury market and inflation. They tend to disagree with what you're saying about with the yield curve the way it is. Why is that, and where do you think that's headed?
It's because so the question is the inflation rate and the yield curve, are they out of line? And they are, right? I mean, when I teach my class on company valuation, one of the things it's a valuation class. One of the things we talk about is what causes revenues to go up at a company, right? And inflation is one of the key things that causes prices to go up and sales to go up. And so I've historically told my students that the quick and dirty way to get a good forecast of inflation is to look at the Treasury market and subtract off about 50 basis points and call that your inflation rate. And the reason I've historically said that is because the Treasury rate perfectly correlates with the inflation rate. But what has happened with the Fed's desire to try and keep interest rates low is they've artificially caused there to be a disconnect, right, between the historical inflation rate and what the Treasury rates are. And so I don't think it's an accurate measure. And over time, they have to converge at some point. They're not there, though.
We've got time for probably two more questions, and we do have one, again, coming in from our viewers online. What's keeping you up at night economically?
What keeps me up at night economically is I'm retiring, and I'm trying to decide if I'm going to have enough money to, how much assets will I have going into retirement. So the things that keep me up, the ones that bother me the most is I'm worried a little bit about what would be the fallout if the debt ceiling doesn't sort of resolve itself, right? Because my own personal portfolio, I have a lot of treasuries I'm holding. And so I'm trying to think what's going to happen to treasuries if, they can't get the debt ceiling issue resolved. I think there's close to a zero probability that it doesn't get resolved, but I do think that's one thing I worry about. I have some crypto, so I'm kind of watch what's going on in the crypto. I don't have a lot, but those are the two kind of asset classes that are causing me the most concern right now.
And that's a wonderful lead into our next question as well. It comes from one of our students. In your opinion, as an 18-year-old, what would be the best way to invest my money for the future?
I think that's a clear answer because you have a long time. I would invest it in the stock market. I absolutely would just go out and put my money into a mutual fund, or really what I would buy if I were you is I'd just go out and buy an ETF like the S&P 500 ETF, a SPY. I would literally say, put my money in that. You're going to lose money, you're going to make money, but you will earn a lot more by having your money invested in the market over time than you will if you put it into the bank. All right, so that would be my advice. But Maybe you're worried about saving for college and you actually can't afford to take the risk associated with stock prices coming down. If you need money to fund your education, then you should probably protect the money, and putting it into a bank or something like that is probably a much better investment for you in the short term. But long term, I think to me, it's clear you want to be in the market.
Thank you. I think that does it for our time with questions today. Dr. Lewis,
Thanks.
thank you again.
Thanks, Casey.